Hi, this is Dave. In this video, I'm going to tell you what factors will affect the price of a goat. I'm going to use a mnemonic called DIT-VERSE to help you memorize those factors. So, what do I mean by DIT? Firstly, is the dollar. As the dollar strengthens, the price of a goat will fall. It's simply because you can hold the dollar rather than invest your money into the gold, because the purchasing power of that is really good. So they're going to hold it, and hence, of course, the price of the gold will fall. If the dollar is weakened, then surely the price of the gold will increase, because rather than holding the dollars, you're going to invest your money into the gold, and hence, of course, the price of the gold will increase. The second factor will be the interest rates. And if the interest rate actually increases, which means you want to be safe, which means you can put your money into the bank, and hence, rather than investing your money into buying the gold, and of course the price of the gold will fall. If the interest rate falls, of course you're not going to put your money into the bank because you think that is not attractive at all. As a result of that, of course, the price of the gold will increase because you can spend your money in buying the gold to earn earn a higher capital gain. So, for example, the third D stands for demand and supply. So let's talk about supply. So if the supply of the gold actually increases, because more supplies of the gold you can provide to me, as a result of that, of course, this would decrease the price of the gold, and vice versa. But for the demand, if the demand of the goat actually increases, of course, the price of the goat will actually increase as well. This will push up the price of the goat, and vice versa. It's the positive relationship. So, on the left-hand side of the page, as you can see, yes, the dollar interest rate as well as the supply would be the negative relationship, which means as one increases, another will decrease. But for demand, it's the positive relationship. So let's look at the right-hand side, which is the VERSE. W-O-R-S-E. Firstly, talking about the wars, if a war happens in the worldwide, and also some of the tragedy happens, of course, this will increase the price of the gold. The simple reason behind it is that, for example, if the wars take place nowadays, and maybe you're running a risk that your money would be devalued, and hence, of course, you're going to invest your money into buying the gold in order to, save your money. The O stands for the oil prices. If the oil prices actually increases, and because we know that we use the oil in manufacturing in forming into many products, and the oil price will forms the major costs for many of these products. And hence, if the oil price actually increases, this will push up the costs of many of these products. As the cost of the products actually increases, of course, the inflation will actually increase. And if the inflation actually increases, of course, you'll actually save your money, because if the inflation actually increases, of course, the purchasing power of your currency will be lower, and hence you're going to invest your money into buying the gold, for example, and this will push up the price of the gold, and vice versa. It's the positive relationship. The R stands for rich, which means as people get richer and richer, of course they got loads of money, they've got lots of money, of course they can invest into the gold, to try to secure their money, to try to make their money become safer, and hence the richer the people becomes, the price of the gold will actually increase as a result. The S stands for the significant inflation, which means if there's inflation happens, significant inflation, which means the currency you have would be, the purchasing power of that will be very, very low, and hence instead of holding this currency, you're going to buy this gold, So if there's significant inflation, this will increase the price of the gold as a result. And finally, E stands for the economic crisis. If the economic crisis happens, of course, people like to save their money by trying to invest their money into buying the gold. So, for example, because they know that from the economic crisis perspective, maybe the money will be devalued, yeah? So that this will push up the price of the gold. So you can say on the left hand side, which is the negative relationship between this item with the price of the gold, on the right hand side, that will be the positive relationship between the items and the price of the gold. Okay, so this finishes off the section on what will affect the price of the gold.